What's up, everybody? It's Michael here. You're watching the Stock Market Brief Show. The stock market broke away today, and now we are going to be soon having a test of true strength in this move. We're going to talk about that in today's brief. Today's episode is brought to you in partnership with FTX. More on FTX later. Let's get into today's show. All right, everybody, it's getting interesting. Here we go. So the breakaway, what do I mean by that? Well, we broke out of this previous high right here on the chart. That right there is a gap that is known as a breakaway gap or a runaway gap. What is a breakaway gap? That is right here when we break away from an area of previously resistance and we start running further. Now, a runaway gap is when we're already running through that and then we gap further. So it's kind of a hybrid between the two taking place. Now, the real true test of strength will be underway because we don't know if this is going to be an exhaustion gap either. So it's a little unclear right now. However, there's a couple of things that we want to pay attention to in today's video, and that is where the price action is at. Notice this black line going across my screen. That is what the options market priced in on Friday of last week. So is what we're seeing right now out of the normal? Nope. It is literally just one deviation from what the market priced already in. And we're right there at that upper range. Does that mean it's going to come right back down? Nope. Does that mean it's going to go bust through this? Nope. This is its happy place, and this is where it gets defended. Okay, so understand that if price continues to perpetuate to itself up, new dynamic hedging takes place as we're coming into quarter end, and that could perpetuate us even further of a squeeze to the upside. However, what is good to know is 68% of the time, price action closes within this range. So there's still a lot of volatility. Now ask yourself why this is important to know. Well, because if you're planning on going long right now at this particular point in time, would it be good to do so right here? Well, as it stands right now, there's more risk to the downside. The market has already made its expected move in the last 2 days of trading. So there's more room for downside than there is reward to the upside, at least where we stand currently on this chart. So it's going to be an interesting thing. Now, if we take a look at the 15-minute time frame, we closed. Well, just about closed. The gap that's right above us, and we have a subtle divergence there on the RSI and a divergence there. So a reconnect to the 5-day moving average seems plausible at some point here, but it just hasn't happened at this particular point in time. If we take a look at the Qs is getting over the risk range. And also we had that runaway gap, breakaway gap, whatever one you want to call it. And back above that 200-day moving averages. Back above this has a new high, so we'll see if that can continue to hold. Obviously, the market has been running. Now, what do I mean by test of strength? If this is really strong, well, first and foremost, we haven't tested any support, let alone we haven't really tested any resistance. The market has gone straight up, and it's been closing at pretty much either the high of the day or the low of the day for 10, 12 straight trading days. So we haven't actually had a period in time where we can actually truly test an area of resistance, or I should say even support, because the market's been going straight up. So by a true test of strength, we need to see the market pull back, and we need to see it touch an area of support and hold, right? Because if this thing just were to come back all the way down, well, first and foremost, that'd be crazy. All right, and then it would just blow through all of these levels right here. So where can support be? Well, support could be right here. That's the previous support, 350. That's what I'd be looking for if we do all of a sudden get a big move to the downside. That'd be right there on the Qs. If we take a look at the S&P 500, where would that be? You can also look at those 5-day moving averages, but also potential gap fill to see if it can backfill and hold. Okay, there's a bunch of different areas where you can pay attention to, but we have not seen that yet. If we take a look at the 15 minutes on the Qs, extended as well, negative divergence, and you can see here we got outside of the risk range and we started pulling back in, we touched it again, and then we bounced from that level. We have the PMO down here, it's also a divergence, so we're going to continue to monitor that as well. So maybe a potential reconnect with the 5-day moving average this week could potentially happen. We'll see. We will see, because being that it's quarter end, like I said, these markups can get insane. IWN, bam, right at that upper risk range. So right exactly where the market wanted it, and you can see here, boom, we broke out of that bull flag. So can there be more room to go upside? Yeah, just be mindful that 68% of the time it finishes within this area, okay? So let's continue on to the 15-minute time frame. 15-minute time frame is also showing a negative divergence, getting pretty separated from that 5-day moving average, and we have that breakaway gap right there too as well. And you can see here as the market's been pressing higher, momentum hasn't really been supporting that move. If we take a look at the volume shelf profile, these act as magnets. So don't be shocked if we get a pullback, right? Just be prepared for something like that. But as it stands right now, market continues to move forward. Now there's other indications here that the market might be running out a little bit of steam for this week. Although, the seasonality thing got me all kind of confused. Before we get into the sectors that I want to talk about also in their risk ranges, why also getting outside of its risk range. You can see how it's been doodling around there and it broke above that area of resistance as well. So a lot of strength coming into the market overall, but just be mindful of these large moves. And now we're back above over those risk ranges, expected moves that last week priced in. Same thing with XLK. So we're talking XLY and XLK. They make up a big percentage of the S&P 500. So it's important to watch that. XLK, interestingly enough, previous support. All right. Come back to the left here, or right side of the screen. 165, that was resistance. Now we're right here and we're just above that risk range too after already a strong move. So the reward to going long right here is clearly smaller than the possibility of downside. So we just need to be mindful of that. XLE, energy tagged the lower risk range. And now it's starting to move back up. So you can see here how important these are. If you knew this going into obviously this week, and we started heading down, you would have noticed that the 20-day moving average, and it's getting outside of its risk range, might be a good opportunity to potentially go long and see if we can catch up a bid. Now, oil has been massive amounts of volatility. You can see here it's doing the same thing. Bam, we had a low of 98.44 and a high of 107. So huge range continue, just massive volatility here in the markets, which is great for shorter term traders and also swing traders to an extent too as well. Here's the midterm election pattern, the blue line. And what I find interesting here is March has been going straight up. And typically you get some sort of a pullback in the midterms in March, but we haven't got that pullback. And then April, you typically get more of a rally too. So perhaps this March has kind of pulled forward, what was going to be taking place in April. So we'll see here if that's the case. Can't tell you right now, but now I will go over this. If we want to see continued strength here too as well, housing is going to have to break out. Now, I find that hard to actually take place. It was a nice gap and move today, up 2.77 in the housing index. Clearly, we still have that negative divergence it's forming here between the S&P 500 and housing. And then you could look at the lumber to gold ratio. It is risk off at this current moment, telling us to, hey, keep your foot off the gas here. There's a couple other indicators that Michael Guyad looks at, and those I believe are risk on at this current point in time. Another found interesting thing was if you look at the relative strength between growth and value, meaning you can look at growth thinking mega cap stocks or growth stocks, whatever the case may be. We've talked about this positive divergence on the rate of change and possibly breaking out of this little pattern here on the RSI. We broke out, we started moving higher, but what I want to point out here, the rate of change on the 10 period, as the price action or the price moved up between the relative strength line, this actually came down a little bit. So perhaps the rate at which this is moving up is now an early indication that it is slowing down. All right, everybody, that's all I got for you on today's episode. Just to conclude, the reward to the upside is clearly diminished to the risk that is on the downside, so be mindful of that. That doesn't mean go short into this crazy squeeze, but it does, if you are familiar with shorting, you can potentially start adding to positions. I'm waiting for some sort of a pullback or various stocks that are tightening up so I can back into that risk. Hope that helps on today's episode. See you back here on the next.